Hello class, this is chapter 11 for accounting 200. We're going to look at liabilities, bonds payable, okay? So here are the learning objectives. Describe the characteristics and terminology of bonds payable. Describe and illustrate the accounting for bonds payable. Describe and illustrate the reporting of bonds payable. Describe and illustrate how the times interest earned ratio is used to evaluate a company's financial condition. And here are two other objective application 1 and 3. So nature of bonds payable. A bond is a form of interest-bearing note. Like a note, a bond requires periodic interest payments with the face amount to be repaid at the maturity date. As creditors of the corporation, bondholder claims on the corporation's assets rank ahead of stockholders. So a bond issue is normally divided into a number of individual bonds. The face amount of each bond, called the principal, is usually 1,000 or a multiple of 1,000. The principal must be repaid on the dates the bonds mature. The interest on bonds may be payable annually, semi-annually, or quarterly. Most bonds pay interest semi-annually. The underlying contract between the company issuing the bonds and the bondholders are called bond indenture. The two most common types of bonds are term bonds and serial bonds. When all bonds are of an issue mature at the same time, they are called term bonds. If the bonds mature over several dates, they are called serial bonds. There are also a variety of more complicated bond structures. Ones that may be exchanged for shares of common stock are called convertible bonds. Bonds that may be redeemed by the corporation prior to maturity are called callable bonds. When a corporation issues bonds, the proceeds received for the bonds depend on the face amount of the bonds, which is the amount due at the maturity date, the interest rate on the bonds, the market rate of interest for similar bonds. The face amount and the interest rate on the bonds are identified in the bond indenture. The interest rate to be paid on the face amount of the bond is called the contract rate or coupon rate. Don't worry about the dog, he's just barking. So the interest rate to be paid on the face amount of the bond is called the contract rate or coupon rate. I think I already said that. The market rate of interest, sometimes called the effective rate of interest, is the rate determined from sales and purchases of similar bonds. The market rate of interest is affected by a variety of factors, including investors' expectations of current and future economic conditions. By comparing the market and contract rate of the interest, it can be determined whether the bonds will sell for more than, less than, or at their face amount. So here's an example graphically. I usually see things better graphically than a bunch of text. So if market rate is greater than the contract rate, then selling price less than the face value, sold at a discount, okay? So if market rate equals contract rate, then selling price equals face amount, sold at face amount. If market rate is less than contract rate, okay, then selling price is greater than face amount, then it's sold at a premium, okay? So that's kind of what some of this is talking about. Proceeds from issuing bonds. If the market rate equals the contract rate, bonds will sell at the face amount. If the market rate is greater than the contract rate, the bonds will sell for less than their face value. The face amount of the bonds less than selling price is called a discount. If the market rate is less than the contract rate, the bonds will sell for more than their face value. The selling price of the bonds less than the face amount is called a premium. So this is the text that I was talking about. The price of a bond is quoted as a percentage of the bond's face value. For example, a $1,000 bond quoted at 98 could be purchased or sold for 98 or $980, which is 1,000 times 0.98. Likewise, bonds quoted at 109 could be purchased or sold for 1,090, which is 1,000 times 1.09. So here's a little quick check. Match the bond terminology in the left column to the correct definition from the right column. So I'll go ahead and let you So here's the questions, and or matching them. Go ahead. This is also in the textbook. So the answers are B, D, A, C, E. So I'll go ahead and let you go through that. When bonds are issued at less or more than their face amount, the discount or premium must be amortized over the life of the bonds. At the maturity date, the face amount must be repaid. So here's an example. Face amount is $1,000 or $100,000, 12%. Term is 5 years. Market rate of interest is 12%. So we're going to receive cash of $100,000, bonds payable $100,000, and then here it says issued 100,000 bonds payable at face amount. So interest expense. So we're going to take. It'll be 6,000, which we get 1,000 times 100,000 times 12% times a half a year. So then we're going to go. This is paid twice a year, biannually. And when we calculate that, we'll get 6,000. So our interest expense will be 6,000, and then that's coming from our cash, paid 6 months interest bond. At the maturity date, the payment of the principal of 100,000 is recorded as follows. So we pay the interest at 100,000, though our bond is debited and our cash is credited for 100,000. Bond issued at a discount. Okay, so 100,000, 12%, 5-year market rate is 13%. So cash of $96,406 and discount on bonds payable of $3,594 and the bond payable of $100,000. Okay, and don't forget this is at a discount. So the $96,406 is the amount investors are willing to pay for the bonds that have a lower contract rate of interest, 12%, than the market rate, 13%. The discount is the market's way of adjusting the contract rate of interest to the higher market rate of interest. The discount on bonds payable is a contra account to bonds payable and has a normal debit balance. It is subtracted from bonds payable. Disregard that. Bonds payable to determine the carrying amount or book value of the bonds payable. The carrying amount of bonds payable is the face amount of the bonds less any unamortized discount or plus any unamortized premium. Okay, so every period a portion of the bond discount must be reduced and added to interest expense to reflect the passage of time. This process, called amortization, increases the contract rate of interest on a bond to the market rate of interest that exists on the date the bonds were issued. So here's an example. If you were to do this interest expense, again, expenses go into your income statement, will be debited, and your discount on bonds payable will be credited. So the preceding entry, here's another example. In the latter case, the entry would be as follows: semi-annual payment, interest expense, bond discount, and then cash amount of semi-annual interest. So those are a couple of adjustments or off of the main way to account for this. Amortizing a bond discount. The two methods of computing the amortization of a bond discount are as follows: straight line method or effective interest rate method, sometimes called the interest method. Okay, the effective interest rate method is required by generally accepted accounting principles. However, the straight line method may be used if the results do not differ significantly from the effective interest method. The straight line method of amortization provides equal amounts of discount or premium to be written off to interest expense each period. Keep in mind these are going to interest expense. To illustrate amortization of the Western Wyoming distribution bond discount of $3,594 is computed as follows. So discount on bond payable is $3,594. Term of bond 5 years. So a semi-annual amortization, all we do is take the $3,594 divided by 10 periods. Okay. So here's what this would look like: interest expense of $6,359.4, and then cash of $6,000, and then the difference will be $359.40. So that's how we account for that entry. The effect of the discount amortization is to increase the interest expense on every semi-annual interest payment date. In effect, this increases the contract rate of interest to a rate of interest that approximates the market rate. As the discount is amortized, the carrying amount of the bond increases until it equals the face amount of the bond on the maturity date. So here's another example. We'll take a look at this. 1 million 6% 5-year bond receiving cash of $936,420. So this is at a discount. Okay. So we'll take a look at A, B, and C, the journal. Those not journal, but the what they're asking us to do, the components. So we'll take in the cash as $936,420. Discount on the bond is $63,580. And then on our books, we'll go bond payable for $1 million. So the interest expense on that is going to be $36,358. So that bonds payable discount is going to give us, it's, by the way, that's 10% of that over there. Okay, so cash of $30,000. And then on December 31st, $36,358. And then there's our discount. We're still receiving cash of $30,000. So there's the bond discount. So initial carrying amount of the bond is $936,420. Those are our two discounts. So our carrying amount at the end of December 31 is $949,136. Okay, so that's how we look at bonds. Bonds issued at a premium. So this is over the amount on over the amount of the face value. So 100,000, 12% 5-year, and the market rate of interest is 11%. So we're going to get cash of $103,769, and then we're going to say premium on bonds payable $3,769 over the 100,000. So like bonds discount, a bond premium must be amortized over the life of the bond. The amortization of a bond premium decreases the contract rate of interest on a bond to the market rate of interest that existed on the rate of the bond on the dates the bonds were issued. So here's the entries. Bond on premium payable, we would debit it, and then interest expense would be credited. And then interest expense down here, debited. Bond premium on bond payable will be debited, and then cash will be credited. Okay, so let's take a look at this. Premium on bonds payable was $3,769, 5 years. So then we'll divide it by 10 periods, because the reason why it's 10 is because, remember, it was semi-annually. So we did 5 and then twice a year time. So 2 times 5 gives us 10. So $376.90. Okay, and no, don't forget that's straight line. It's not a percentage. So interest expense will be $5,623.10, and the remaining will be $376.90. And then our cash will be $6,000. Okay. And let's see, the effect of the premium amortization is to decrease the interest expense on every semi-annual interest payment date. In effect, this increases the contract rate of interest to a rate of interest that approximates the market rate. So here's another checkup corner. Also, we'll take a look at ABC. This is a $2 million, 8% 5-year bond receiving cash of $2.17 million. Due on June 30, so semi-annually, and we're looking at the straight line method. So cash of $2.17 million, 600,000. So premium on the bond will be 170,600. So $2 million. So those have to equal. So that's how much cash we received. Interest expense will be 62,940, and our bond will be, don't forget, this is 10% of the premium. So 17,060. And then that has to equal 80,000. Okay, so now we're gonna look at the amortization. Interest expense will be 62,940, and the bond premium payable will be 1,760, and then 80,000 as well. So our 2,170,600. Add those up as well. Don't forget, this is only a year. So we would do this each year for 5 years. So this the carrying value now is going to be $2,136,480. So bond redemption: a corporation may redeem or call bonds before they mature. This is often done when the market rate of interest declines below the contract rate of interest. In such cases, the corporation may issue new bonds at a lower interest rate and use the proceeds to redeem the original bond issue. Callable bonds can be redeemed by the issuing corporation with a period of time and at the price stated on the bond indenture. Normally the call price is above the face value. A corporation usually redeems its bonds at a price different from the carrying amount or book value of the bonds. A gain or a loss may be realized on a bond redemption as follows. A gain is recorded if the price paid for redemption is below the bond carrying amount. A loss is recorded if the price paid for the redemption is above the carrying amount. Okay, and I know all of this is a lot of wording, but hopefully we'll look at it here in a bit. Gains and losses on the redemption of bonds are reported in the other revenue expense section of the income statement. Other revenue or expense. Okay, so keep that in mind. If it's a loss, then it's an expense. If it's a gain, then it's a revenue. To illustrate this, so we'll take a look at this on June 30, 100,000. Face amount of a bond, premium on the bond is payable is 4,000. So here's what this will look like. Okay, so we'll do a bond payable of 25,000, bond premium of 1,000. Okay, so cash will be 24,000. Gain on redemption of bond will be 2,000. Okay, and the redemption is 25,000. Bond for 24,000. Okay, now keep in mind we're basically going to do 1,000 off. We're going to do 4,000 divided by 4 to get 1,000. That's how actually it is 1,000. Okay, so that's how we get 2,600. So our gain is actually 2,000. Okay. Let's see. Assume that, so here's the remaining 75 is outstanding, which are held by a private investor for 79,500. So we got, so we're paying this out, 79,500. The bonds payable remaining is 75,000. The premium is 3,000, and the loss on redemption will be 1,500. So keep in mind these all have to equal what the price is that is being called for. Okay. All right. So bonds payable are reported as liabilities on the balance sheet. Any portion of the bonds. Keep in mind, these bonds, people gave us money, or some investors invested in these bonds, and then they gave us cash. I know schools and whatnot do bonds. Businesses do bonds as well. But when a bond is done, then they have to pay it back monthly, quarterly, or biannually, or annually. Just depends. Any portion of the bonds that is due within 1 year is reported as current liability. The remaining bonds are reported as long-term liability. By the way, this usually happens for larger corporations. You typically won't see these bonds payable on small businesses. So any unamortized premium is reported as an addition to the face amount of the bonds. Any unamortized discount is reported as a deduction from the face amount of the bonds. A description of the bonds should also be reported either on the face of the financial statements or in the accompanying notes. So keep that in mind. So reporting bonds payable. So here's an example of the bonds right here. They're also on the balance sheet. Okay. Notice how every one of them is in the notes through the financial statement, but all this will equal right there long term. Okay. So keep that in mind. And we actually don't use any bonds or anything like this for up at NAPI. So this is definitely something that's unique to like really large corporations. And NAPI's at probably about $500 million, but this is for like, notice how it says there. Well, it doesn't say this. This is probably in the 30 million range. Actually, probably like 30 billion or so. So decision making, so if we're looking at times interest earned, it's income before income tax plus interest expense divided by income expense. So that's how we're going to look at this. It says values of this ratio less than 1 suggests that the firm is unable to cover interest payments from current period income before tax. Okay, so just keep that in mind whenever you look at that. So then here's some examples: Pepsi and Pepsi Company, Coca-Cola, Dr. Pepper, Snapple, and then Monster. So there's our interest expenses, income before, income tax is right there, and then interest expense for each of these is right there. Wow, look at that, 68. Okay. So here's what we're looking at. Times interest earned. So if you look at all the values and then you divide them, Your percentage is 7.4, 12.1, 9.7, and then 15.878. Okay. Now keep in mind, look at this. The ratio computes the number of times interest payments could be paid out of current period earnings. The number of times. So then right here, this one is 7.4, 12.8. So this one can pay it 15,878 times that amount, okay? And then this one is 9.7 times, 12.1, and 7.4. That's what it's looking at, okay? All right, so when a corporation issues bonds, the price that investors are willing to pay for the bonds depends on the following: the face amount of the bonds, which is the amount due at the maturity date, the periodic interest to be paid on the bonds, and the market rate of interest. An investor determines how much to pay for the bonds by computing the present value. And if you take finance, you'll look at present value, future value as well. So those are some cool things to look at. And then the fair market value as well. So sorry to sidetrack on that, but it's pretty cool to see all of that. And when you get to advanced accounting, you'll actually how to account for future value, present value, and market value in accounting. Anyway, the bond's future cash receipts using the market rate of interest. A bond's future cash receipt receipt include its face value at maturity and the periodic interest payments. So let's see, present value is the current worth of a future sum of money or stream of cash flows given a specific rate of return. The amount to be received in future, if you make a deposit now, is the future value. Okay, so this is looking at time value of money concept, and that's what I was talking about when you get to finance. So present value of 1,100 to be received 1 year, 1,000 today. Interest rate of 10% is 1,100. So 1 year from today, it's worth 1,100. So the future value of 1,000 received 1 year ago. Okay, so that kind of takes into account not only interest rate, but oh man, I forgot the term. Well, anyway, it's the amount of money that you would pay right now in the future, or if you get a loan, how much it would be worth whenever you pay for it today. Okay, so just think of it like that: present value and future value. Present value of an amount to be received in 1 year. Okay, so if you're going to be in $1,000, this is what it would be: $909.09, and that's at an interest rate of 10%. So you'll look and adjust the interest rates as well. In 2 years, 10%. If you want to pay back $1,000, this is how much you'll have to invest at 10%. Okay. Let's see. The present value of an amount to be received in the future can be determined by a series of divisions or by using a table of present values. Present value of dollar table is used to find the present value factor of $1 to be received after a number of periods in the future. The amount to be received is then multiplied by this factor to determine its present value. So here are these values. Okay, and this is compound interest rate. That means each month or depending on your terms. So let's see, a series of equal cash receipts spaced equally in time is called an annuity. The present value of annuity is the sum of the present value of each cash receipt. Okay, so present value of an annuity, $100 year 1, $100 year 2. So and this is in the table, and it depends on the percentage. So this will be $90.91 today, and then sorry, people are walking by outside. And then $82.64 for year 2, so a total of $173.55. Okay, which is how much we'll need to invest to have $200 in 2 years. All right, the present value of annuity of a dollar table can be used to find the present value of an annuity, the present value of an annuity. By the way, a graphing calculator can do this. A TI-85, I think, can do this. Okay. All right, let's see. So here's the table of $1 of compound interest. So this is also in your book, so I won't really, this is a table, so this really doesn't, you can look up the table and see what it is as well. So the selling price of a bond is the sum of the present values of the face amount of the bonds due at the maturity date, the periodic interest to be paid on the bonds. The market rate of interest is used to compute the present value of both the face amount and the periodic interest. So to illustrate the pricing of bonds, assume that Southern Utah Communication Inc. used the following bond on January 1. Face amount 1 million, or no, 100,000, contract rate 12%. And let's see, term of bond is 5 years. Okay, so here's what it will look like. So we're going to go 100,000 times 0.55. And by the way, this was in the table, 12%. So $1 for 10 periods, 6% from Exhibit 5 will be 55,839. Okay, and then 10 semi-annual interest payments of 6,000. Present value, $1 for 10 periods at 6%. Exhibit 7 is 44,161. So that totals of 100,000. So keep that in mind. That is based on these tables, this table and this table. Okay, and depending on the percentage. So look, it said 12%. Okay, let's see. So 12%, and depending on the periods. So that's what we looked at, 12%, and that's how we got this number. So if you went 12%, let's see, for 5 years, which one was it? 12% for 5 years. So we got 0.56 right there. Okay, so that's how we got those values. That, and then same with this one. This one will be on this table right here. Oh, they passed it. 12 years, right in here somewhere. Let me see the number. So 736. 6736 right there. Okay, so that's how that's where those come from. Keep in mind though, this also can be done on a calculator, but until you get to finance, you won't be able to do it without a table or understand it. So here's 13% bond, 96,406. So 100,000 times 5.5327. 0.53273 will be again 53,273. And then the remaining 6,000 will be times 7.1883 will be 43,133 or 96,406. Okay. And then here's 11%. Again, these are from the tables. 11% and then 11%, 10 semi-annual payments. And these are the values, 103,769. Effective interest rate method. The effective interest rate method of amortization provides a constant rate of interest over the life of the bonds. This is in contrast to the straight line method, which provides for a constant amount of interest for each period. Okay, so the interest rate used in the effective interest method of amortization, sometimes called the interest method, is the market rate on the date of the bonds, or on the date the bonds are issued. The carrying amount of the bonds is multiplied by its interest rate to determine the interest expense for the period. The difference between the interest expense and the interest payment is the amount of discount or premium to be amortized for the period. Okay, so face value 12%, 5-year interest compound semi-annually, 100,000. Effective present value of the effective market rate of interest of 13% will be 96,406. So discount on the bond will be $3,594. Okay, so here's the amortization table. Okay, again, interest is 6,000. Amount, amortization B minus A, 266. Those are the values. Amortization discount D minus C. So this minus C will give us this value, right? Well, hang on. Whenever we deduct 96, where was that? Right here. This 100,000 minus D. So minus there, minus there, minus there, minus there, and so on and so forth. Okay. All right, so let's see. Amortization of discount on bond payable. So this is another one, another example. Okay, so go ahead and look through that table. And then amortization of discount by the interest method, as shown in the amortization of discount of bonds payable table. Payable table, that sounds funny. Interest expense increases each period as the carrying amount of the bond increases. The unamortized discount decreases each period to 0 at the maturity date. Finally, the carrying amount of the bond increases from 96,406 to 100,000, the face amount at maturity. Okay, let's see. So here's how we take this into account on the books. So interest expense of 5707, premium on bond, $293, but keep in mind it still has to equal $6,000 because that's the cash payment. Okay. 103, 769 to 100,000, so the premium is going to be 37.69. These are very similar to the previous example. This is the premium, the other one was a discount. Okay, so here are the tables, the amortization of the premium on the bond, and don't forget this is going, it should be going down from 103 down to basically 100,000 at the end. Okay, so this is what it would look like going down all the way to 100,000. So as shown in the amortization, the premium of bonds payable bonds payable table, interest expense decreases from each period as the carrying amount of the bond decreases. The unamortized premium decreases each period to zero zero at the maturity date. Finally, the carrying amount of the bond decreases from 103,769 to 100,000. So that's what I was talking about, down to the face amount. Okay, and here's how we account for that: 5707, and this is a premium of 293, and this is, we're still paying it in cash. Okay, let's see, and that's the end of this presentation for chapter 11. Okay, and bonds are a big thing. It is one thing to look at, but you know, future value and the present value, we have to take those into account. So feel free to you know, ask questions or anything. I can help you. Also, if you have homework that's missing, please get that in to me. Thank you and have a good day.